Welcome everyone to our Refinitiv webinar, Approaching USD Libor End Date. Are you ready for a new beginning? I think that's a big question. First of all, I'd like to start by giving a big thanks for registering and attending the event. It's really great to see so many people logged in for the webinar. Of course, we want the event to be as interactive as we can, so we encourage everyone to ask questions during the event using the chat button. So normally on the screen you should see it. So we'll take questions. We'll try to reply on the fly on the chat, but we will also allocate 10 minutes for questions at the end, so that we make the best of the time of the hour we have together. If we have questions that we cannot answer, we will take them offline and then we'll reply back to you directly. So let me introduce myself. I am Alex Ardouin. You can hear from my accent, even if I'm trying to hide that I'm French. I'm based in Geneva, Switzerland. I am the Fixed Income Desktop Director for Refinitiv globally. So I'll be moderating the webinar, and I'm happy to introduce our panel speakers, starting with Marcus Burnett. Marcus, can you introduce yourself, please?
Yeah, Alex, thank you very much for the opportunity to join this discussion today. My name is Marcus Burnett. I'm the Chief Executive of SOFR Academy, based here in New York. We provide digital education and unique market data, and our team's a combination of academics and former rates traders. The academics are from schools like Harvard University, UC Berkeley, MIT in the UK, London Business School, University of Oxford. And then the rates traders are from banks like Deutsche Bank, JP Morgan, Credit Suisse. And I've been involved in Libor transition for about 4 or 5 years now, beginning with some of the early working groups in London chaired by the FCA. Delighted to be here today. Thanks, Alex.
Thanks a lot, Marcus. Marcus, we will deep dive into the credit-sensitive spreads with Marcus. That is a very hot topic, especially for USD. Next, Philippe Whitehurst from LCH, which is also an LSEG business similar to Refinitiv. Philippe?
Alex, thank you. Good morning, good afternoon, everyone. Phil Whitehurst, Head of Service Development for LCH's rates businesses, which include the swap clear service. And yeah, I've been representing us on a number of the public-private forums for looking into benchmark reform across a number of currencies and jurisdictions. So obviously US dollars is the big one, so look forward to today's discussion very much.
Thanks. So yeah, with Philippe, we will deep dive into the cleared derivatives with a focus on USD, obviously, given what he's doing with LCH. David Pichowski.
Yeah. Hi, Alex. Thanks for having me today. David Pichowski, Director of Market Analysis for Refinitiv LPC. We cover the corporate loan market. LPC has been doing it since the 1980s, and we cover it globally. And as most people probably know, loans are a floating rate asset that have been historically tied to Libor here in the US. So the transition over to SOFR was a big deal, has been for the last couple of years. So happy to walk you through some analysis that my team put together recently.
Yeah, the LPC report on USD loans is really great. So we'll have time with you to go through this. So let me start with a short introduction and remind you, I think it's a reminder for everyone, what are the key Libor dates, and also give you a view of some adoption statistics that have been put together by ISDA on that topic. So just in terms of key dates, so here it's only the key ones. There has been plenty of intermediary steps, and we focus here mainly on US. 31st of December last year, so GBP, GPY, and CHF Libor has been discontinued, which means that the transition is over even in these jurisdictions, even if for GBP and GPY, there is that concept of synthetic Libor that is going to disappear. EUR Libor is not very active, so Euro is still very much on Euribor. The other big news is that the end of publication for USD Libor has been set and confirmed to the 30th of June 2023 for all the remaining tenor overnight 1 month, 3 months, 6 months, and 1 year. Similarly for Canadian CDOR, the end of publication, and Refinitiv is actually the benchmark administrator for this one, has been set to the 30th of June 2024. In the meantime, what is important to remember is that in December, since 31st of December 2021, US supervisors have very clearly stated that there should not be new USD Libor products, so it's really already the case. I will skip the other dates, but really that's if you remember, only one is 30th of June 2023, so that's why you need to be ready for the new beginning. Post-Libor world is coming. In terms of adoption statistics, I won't comment each of the figures, but just look at the trend. You'll see that adoption of SOFR is growing, even if there is still a large portion of the business that remains on Libor. But if you look at open interest on SOFR futures, it continues to increase. For swaps, you see that the trade counts on SOFR is going up, and same for the notional. So more and more are traded against SOFR and not Libor anymore, especially for maturity after the 30th of June 2023, because now we have an end date. So now the question is, what is going to replace USD Libor? Not exactly replace, but what is available to do the same things that people were doing with Libor. So there is several rates that you have to take into account. So for the main one is SOFR, that is used for cash and OTC derivatives. That's an overnight rate. It's not forward-looking as the Libor were, and it has no term structure. That's only an overnight, and also missing a credit risk component. We'll come back to that with Marcus. Term SOFR has been introduced, so you can find a term SOFR market data in Refinitiv Icon or Refinitiv Workspace. So for term SOFR, there is a term structure overnight, 1 month, 3 months, 6 months. And it's easier to use than SOFR. So that would be typically used for cash loans, for instance, and David will comment on that. Then you have two types of fallbacks that have been introduced. So Refinitiv USD IBOR cash fallback, mainly for FRNs, for instance. They are based on SOFR and they use a fixed spread adjustment. And ISDA fallback that have been introduced a while ago, and the value has been set in March last year. The last aspect is the credit sensitive rates. Again, we will deep dive into this, which are operationally very similar to Libor, but there is a question mark as to are they endorsed by regulators, and Marcus will come back to that. As a market data and analytic vendor, we do have all the market data that you need to navigate the transition. So we have the risk-free rate fixings, we have the term rates, even if those term rates are administered by other providers. We have the credit-sensitive spreads. We have, for rates derivatives, broker data. So now we are receiving questions. So OIS have been live for quite a while, but now basis swap, cross-currency basis swaps, and we do see now caps floors, volatilities and swaption skews also on the new risk-free rates. Obviously, for the bonds that have transitioned to SOFR, you need to be able to identify the fallback. That's something we have as well. And not only we have the market data, but we have analytics. We have produced zero coupon OIS curves. We have updated our analytics, the bond calculators to price FRNs, the swap pricer to price rates derivatives from OIS, basis swap, cross currency basis swaps, and also we are exposing the curves that are becoming really popular. So this is how the app look like in Refinitiv Icon and Workspace desktops. It's a kind of website, very easy to use, where you find very easily each of the market data you need, from the term rates to the fixings to the broker data, rates derivatives, ISDA fallback. So we are an official redistributor of the ISDA fallback. So just before in my little introduction, I was referring to credit-sensitive spreads. So it's great to have Marcus with us from SOFR Academy. Marcus, can you tell us why is there market demand, specifically in the US, for credit-sensitive supplement to SOFR? And also, we hear a lot about those Ioscope Principles. Hope I'm pronouncing well. Can you tell us why are they important, please?
Yeah, thanks very much, Alex. So maybe just to take a quick step back, in September 2019, a group of, I think, 8 or 10 large US regional banks sent a letter to the official sector, to the market regulators, basically expressing their support for SOFR, but also expressing a concern that perhaps in times of market stress, credit-sensitive rates and their funding costs tend to go up, move a little higher, whereas risk-free rates like SOFR tend to move lower in tandem with the Fed funds rate. And so they're a little bit concerned that in times of market stress, there may be a mismatch in their lending compared to where they actually fund those loans at. And so they proposed a framework whereby a credit-sensitive supplement could be used in conjunction with a secured overnight financing rate. And that's effectively the approach that we're taking, and the approach that the academic architects of AXI, the across-the-curve credit spread, have followed. So in response to that letter, the official sector set up a series of workshops, the credit sensitivity group workshops, where a credit-sensitive supplement to SOFR was explored, and it was those sessions where Professor Darryl Duffy from Stanford University, Professor Antje Burnett from Australian National University, and Professor Yichao Zhu, also from ANU, first introduced the concept of across-the-curve credit spreads. And the key point here, the key approach with across-the-curve credit spreads, AXI, is that really banks don't fund themselves at LIBOR anymore. And we know that because there are actually not enough transactions with this to compute LIBOR anymore, and that's why it's going away. And so where are they funding themselves? They're actually funding themselves further up the curve. And that's a trend that really began after the financial crisis in 2008, 2009. So AXI actually goes out the curve, the yield curve, and captures those deeper, longer pool of bank funding transactions. And that's what is the primary input data for the credit spread. You mentioned the Ioscope Principles, Alex. I think it's a really important point. And the approach, again, that Professor Duffy and his academic collaborators took really fundamentally to that was that the Ioscope Principles are important. So the Ioscope stands for the International Organization of Securities Commissions. They're an association of organizations that regulate the world's securities and futures markets. The chair of the SEC, Chad Gensler, I believe, is on the board, as well as the chair of the CFTC, Chad Benham. And in 2014, they put together some principles for international best practice in relation to financial benchmarks. And I'm going to talk about two of those principles just now, Principles 6 and 7. There's 19 principles in total, and the majority of them actually refer to the benchmark administrator, things like governance, oversight, controls. Principles 6 and 7 actually refer specifically to the benchmark. So you can see here that the approach that Professor Duffy and his collaborators took, it was sort of a three-pronged criteria. One, the rate must be highly correlated with the cost of banks' funding, and therefore have hedge effectiveness that correlates directly to Principle 6, benchmark design. And when you actually look at where the banks are funding themselves, again, you're actually not going to create something that looks like LIBOR, because actually LIBOR is not a very good representation of banks' funding costs anymore. The second point is robustness. So we need a really large pool of transactions underpinning the index, because we know that when a bank writes a loan referencing SOFR plus an XI, they're probably going to want to hedge it. And so there needs to be enough transactions underpinning the rate to allow for a hedging market to develop in association with it. There needs to be a sufficient amount of data. And obviously going further out the curve, getting a deeper pool of transactions achieves that. And then the third point, adaptable to future changes. We want to build something here that can last for decades into the future. We don't want to do Libor transition twice. And the Ioscope team actually put out a statement last year basically saying, look, you can't just have a rate that's aligned with Ioscope principles once. It has to be continually and sustainably compliant at all times. So that was the approach that Professor Duffy and his collaborators took. And what they achieved is actually something quite different to Libor. So it actually doesn't necessarily correlate with highly with Libor. And that's a key differentiating factor between AXI and all of the other credit-sensitive rates and spreads in the market at the moment.
Thanks a lot, Marcus. Really, really interesting. Can you tell us a bit more about what is the approach to AXI construction, really the construction itself of the rate?
Oops. Yep. Yeah, happy to. So, I mean, it's actually quite simple. There's two components. The short end comes from the DTCC, and the long end, which is the bond component, comes from FINRA Trace. So the index is really just a weighted average of the credit spreads of unsecured bank funding transactions, short-term maturities, and then multiple years up to 5 years, with weights that reflect both transaction volumes and issuance volumes. So you can see just a simplified diagram here. The benchmark administrator, we're partnered with Invesco, an American asset manager. The short end, they pull from the DTCC, run a filtering process to ensure that we get only the transactions that we want. We're looking at US banks to calculate the short end. I think that file comes in at about 5:30 p.m. every day. And then the long end comes from FINRA Trace. Again, a filtering process is run before it's calculated. That file comes in at about 7:30 p.m. New York time every night. And then those two components, the weighted average is combined, and that's when you actually get the raw index, what we call unscaled AXI. Interesting that the weighted average maturity of the unscaled AXI looks to be between 2.5 and 3.5 years, which really is supportive of the fact that banks just don't fund themselves in the short-term unsecured markets in the way that they used to in the past. We've actually had some large banks say that they're comfortable using the unscaled AXI on its own. But in addition, in response to market demand, Nesca will be publishing scaled recommended money market tenors. So 1 month, 3 month, 6 months, 12 month. In addition, we'll also be publishing an overnight AXI, which can be added to simple daily SOFR. The combination of AXI and SOFR is referred to as SOFR X. So you'll be able to use AXI in the same way that you can use Libor today. There'll be a nice 3-month tenor that you can use in conjunction with, for example, CME's term SOFR. In addition, for market participants that desire the flexibility of an overnight index swap, you'll be able to do it SOFR X OIS. And one of the advantages of using only data that comes from reliable, trusted, publicly available sources like the DTCC and FINRA Trace is that it enhances and promotes the credibility of the index. Banks have an obligation to really understand where the transaction data is coming from that underpins the indexes that they reference in their loans and in their derivatives. And having two sources that are overseen by the SEC, Securities and Exchange Commission, I think strengthens trust in the index. I'll just touch on our approach. So we began this work first part of last year, and we did have a conversation with our Ioscope team. They're based in Madrid. We notified the ARC, the Alternative Reference Rates Committee here in New York, in the form of a formal letter. And then we hosted a series of meetings with the largest banks in New York and in London, education sessions. Then we moved on to the official sector. We met with, basically met with all the largest regulators in the United States and the United Kingdom. including members of the Financial Stability Oversight Council. The key messages we wanted to communicate there was, look, what we're doing here is actually supportive of SOFR. If a loan references AXI, it'll also reference SOFR. So what we're doing is we're not creating a path for banks to skip over SOFR. Secondly, the approach we're taking actually doesn't look like Libor at all. And then we also spent a lot of time with the trade associations. We're a member of ISDA. The LSTA are playing a really important role here in the US. I spoke to Andrew Ferguson, the CEO of the Asia Pacific Loan Market Association. They're going through all the same challenges in that part of the world. We also held, so we're obviously not a benchmark administrator, so we wanted to partner with a trusted, recognized, experienced benchmark administrator so that this index would be computed and calculated and published at the highest possible international standards. And so we effectively held an informal RFP last year, and then we began speaking with Invesco sort of Q4 last year, put out a public announcement on our collaboration the first part of this year. And honestly, they're doing a fantastic job. They're taking a very, very high level of care. Their quantitative research team and their indexing team are doing a phenomenal job, and we're really looking forward to launching these indexes. Importantly, they're also recognized in the United Kingdom as a benchmark administrator, as well as in the European Union, which I think is an important step, and they operate in alignment with the Ioscope Principles. So, and then more recently, we've been working with ISDA. ISDA published some new definitions, expanded their definitions to allow for AXI swaps. That went live, that was published last month, and they've done a fantastic job, and they've actually set up documentation. So you can actually do one swap to hedge both a SOFR position and an AXI position. So the ease of use is fantastic. And then we're fortunately working with top tier market data providers such as Alex and Refinitiv, setting up distribution of the data. And I'm aware that one of the largest US banks has requested to consume the AXI data via one of Refinitiv's platforms, which is great. And then just recently, last month, we formally notified the New York Fed that we'd be launching these indexes in partnership with Invesco, because as I mentioned, we will be creating all-in rates as well that come from, that are in part based on the SOFR rates that the Fed is publishing and administering. But actually, one other quick thing there, on launch timing, there's a yellow box up there. So what we are looking for really to launch these indexes is deep SOFR liquidity. And Alex, I saw you shared some numbers earlier. You said 50% plus in the derivatives market for last month. We think that now is an appropriate time to launch these indexes with deep, robust SOFR markets that are trading on a sustained basis.
Thanks a lot, Marcus. We know that the absence of the credit component is very challenging especially for the loans business. Can you tell us how can AXI be used in a loan, please?
Sure. Yeah, it's actually quite simple. So we've got a little case study here that just shows how you would use it with CME's term SOFR. We think the CME have done an excellent job in building a very robust benchmark that's got it seems to be going extremely well in the lending markets, and I think David's going to be presenting some more information on this on the lending market. So really, the CME could sit on the bottom. You would add AXI on top of that. That would form the base rate, and then you would use your existing corporate spread. The AXI rate is going to be published every business day at around 9 a.m. New York time. So you would just consume that into your systems the same way you would Libor or any other rate at the moment. So it's actually fairly simple. I think that the advantages of separating it out, and again, I know David's got some excellent data and statistics on this, is I think that you actually provide a little bit more transparency to your borrower and your lender. It sounds like there's a couple of different approaches at the moment to adding a credit spread adjustment. I think that One of the approaches was to add 10 basis points across the curve. Another one was to have a 10, 15, 25 basis point sort of credit spread adjustment curve. And another idea was to embed the credit spread into the overall corporate spread and increase the corporate spread. I mean, to be candid, I think that we speak to a few people on this topic. I think that there really is no consensus at the moment for what the approach should be. We think that actually could be quite helpful in allowing both the borrower and the lender to reference an independently calculated credit spread adjustment that is published in and administered in a regulated environment. You know, we've received significant amount of demand, and we hope that that Csas launch will actually help provide more efficient conversations between borrowers and lenders.
Yes, that's great news. And by the way, you can get the 3 months CME term SOFR, and you will be able to get the 3 months actually, as you said, from Refinitiv directly, as well as other credits sensitive rates and spreads. Can you tell us what has been the regulatory response to credit sensitive rates and spreads? Because we've received mixed messages on that topic.
Yeah, this is obviously an extremely important point and an important slide here. And I wanted to offer one quick reflection that actually came from Morgan Stanley's CEO, James Gorman, in an interview. He was talking about how he thinks about managing his relationships with the regulators. And one of the things he said that struck me, he said, look, you've got to think about things through the lens of the regulator. And I think translating that comment into this context, you know, what are the concerns of the regulators? I would say that there's two main ones. One is safety and soundness of the financial system, which is really the core reason why we're transitioning away from LIBOR. They want to safeguard the financial stability of the system. And to do that, they need to ensure that the rates that market participants use have a sufficient level of transactions underpinning them, and will do into the future. Where obviously, you know, the approach that Professor Duffy took and his collaborators ensure that that's the case, because if banks change their funding a little further out the curve, a little sort of shorter in the curve, well, then that's fine, because Csas can actually capture all of that. And then second, they ask about performance. What they typically don't want to see is something that looks a lot like LIBOR. The period of time that the regulators typically ask about is May 2020, because they want to see how it performed during that period of market stress when COVID first hit. And what happened with LIBOR is it moves higher immediately with a high level of volatility. And at the same time, the number of transactions underpinning the rate dropped off. So that's, I think, what they don't want to see. And then, you know, obviously there's a significant amount of public speeches and other communications where they've been more specific about things they don't like, things like using executable quotes, complex regression models, things like questions like how will the rates and spreads evolve in the context of new regulations such as money market reform. We also know that they don't want rates, they want to see rates that are heavily reliant on the short end of the curve, like commercial paper, certificates of deposits. You know, I think the experience of Professor Duffy and you know, has really shown through here. And he, you know, what he did is fundamentally redesigned credit sensitivity from first principles. What he didn't do, I think, is try to synthetically recreate LIBOR. And I think, you know, I don't think the regulators are ever going to come out and say they love any of these credit sensitive rates or spreads, but to the extent possible, we certainly want to make it as regulatory friendly as possible.
Thanks, Marcus. So in the next part of the webinar, we are going to focus on the US loan market. So let me move on. You have some other materials for XI if you want to come back to this. So David, can you tell us how has the transition away from LIBOR impacted the US loan market based on the great report that LPC has produced a few days ago?
Yeah, thanks, Alex. Before I answer, I just want to preface by saying the charts I'm going to walk you through today were put together by the analyst team at Refinitiv LPC. They were taken from a larger special report that we published earlier this month, and you can receive a complimentary copy of that report by emailing lpc.info@refinitiv.com. And I'm also, working off of Marcus's presentation there, interested to see how if credit-sensitive spreads could kind of make their way into the market and become, more prevalent across the loan market. So now to answer your question, the transition away from LIBOR has mostly been a smooth one so far this year, with the large majority of U.S. Corporate loans having been priced off term SOFR. You can see that on the chart on the left. There was the January 1st, 2022 deadline to stop pricing loans off of LIBOR. But we even saw in 4Q21 several issuers that got ahead of that deadline and used the SOFR rate. One lender told us recently it's been more of a non-event than we would have expected. And earlier in the year, the LSTA, who Marcus referenced, they're the trade group for the syndicated loan market, and they were doing a lot of great work over the past few years to guide the loan market through the LIBOR transition. They compared it to Y2K, where there was all this buildup to the deadline, and then the deadline came and went, and the loan market didn't end. So it's been more of a non-event than an event, according to both the data that we've collected and the people that we talked to in the market. Now, I don't want to minimize any issues that some may be having with converting their base rates, but one thing I can say is we talked to a lot of lenders off the record, and no one has said anything close to the idea that transitioning from LIBOR to SOFR has been difficult. It's been quite the opposite. So you can also see in that chart on the left there that LIBOR was used on a slew of loans at the beginning of the year. This is the black column in the chart. Those loans had been underwritten in 2021, or at least a lot of them, before the Jan 1st deadline for regulated banks to issue loans in an alternate rate. Since February, though, only a very small percentage of loans tied to LIBOR are still seeing their way to market. Those that are, it's typically for add-on loans due to the fungibility with the existing loan. I also want to touch on the direct lending market a little bit. Direct lenders are non-bank lending institutions, and that market's now estimated to be approximately $1 trillion. Since they are unregulated, direct lenders did not have to adhere to the Jan 1st deadline, and thus have been slower to adopt an alternate base rate. In 1Q22, only about half of direct lending deals had pricing tied to an alternate rate, while the other half were still priced to LIBOR. That market will pick up more momentum as the year goes on. Lenders we talk to in that market, more and more are shifting over to SOFR. There just wasn't that strict cutoff date for them. So it'll happen, but more gradually over the next year instead. Now, looking at the chart on the right, you can see that despite what we've talked about already with the early success of SOFR loans so far this year, there's still a long way to go. We estimate around 6,100 borrowers in the U.S. syndicated loan market have active loans tied to LIBOR. That's roughly 11,600 tranches that will need to transition in the next year. And there are three basic ways borrowers can do this. One is a full refinancing of your loan where you switch over to the new base rate. Another is hardwire opt-in with the SOFR fallback language where a trigger event springs the new base rate. And the last is the amendment opt-in with the fallback language, similar to the hardwire, but not done when amending the credit agreement for a specific reason. So the fallback language has been added to credit agreements over the past few years in preparation for the LIBOR transition. So the data we're showing on this slide is full refinancing only. There may be some borrowers triggering SOFR with the hardwire or amendment approaches that we don't have tracked in this data. And one last point I'll make on this is that market fundamentals have shifted this year. With loans being floating rate and interest rates rising, borrowers are, of course, less apt to refinance their loans, lest they pay a higher spread. So the hardwire and amendment opt-in approaches could be the avenues taken to switch over to SOFR as more time goes on in the lead up to the June 2023 deadline when LIBOR will be no more.
Thanks, David. Really interesting stats. How does SOFR stack up to LIBOR when pricing loans, and how have the credit spread adjustment been worked into the formula?
Right. So more importantly is what's happening on the pricing side of loans where this base rate transition has a direct impact on borrowers and lenders. Now, I know this chart looks intimidating, but I'll promise I'll break it down for you pretty easily. This is looking at the rate-related components to an individual's loans pricing. So we're stripping out the spread over the base rate, plus any original issue discounts, and just looking at the rate or the rate floor, if applicable, plus any credit spread adjustments to SOFR. And further background is this is the broadly syndicated institutional term loan market for single B issuers. So it's part of the leveraged loan market. These are the most liquid loans, the ones that trade in the secondary market. So the left-hand side of that left chart, you can see the lines are the LIBOR and SOFR rates themselves. But the diamond markers are the rate that actually applies for each of these loans, since there's interest rate floors on these deals. The rates are lower than the floors during this time period. So the base rate is basically irrelevant because the floor will apply instead. And you see there's floors for 50, 75, and 100 basis points on these loans. It's not until the rate increases above the floors that now the SOFR versus LIBOR comparison can be made. And you see that vertical dotted line there where the 50 bips floor was breached in early April of this year. So now to the right of that line is more of a focused LIBOR versus SOFR plus CSA adjustment comparison. So these loans are all tied to SOFR, but we charted LIBOR along with them in order to provide this comparison. And you can see that there's not too much of a wide disparity there. Sometimes LIBOR is higher on the loan, but minimally, and sometimes SOFR plus CSA is higher, but also minimally. These charts were put together by my colleague, Deanna Dequez, by the way, who did a fantastic job, so I wanted to give her some credit. And what she did on the right there, she averaged out the same data monthly to show a similar comparison. And you can see there's not much of a difference when showing it this way either. Very similar averages across each month. Now in June, you can see a little larger gap, but bear in mind this data was for the first 2 weeks of the month only. So it's across fewer deals, and the LIBOR rate had gapped out over term SOFR earlier in the month. So I would wait to see the full month data before coming to any conclusions there. Moving to the next slide. So these charts shed some light on credit spread adjustments, or CSAs, that Marcus was talking about as well. It's the additional spread added on top of term SOFR to compensate for the difference between LIBOR. And on the left, you see the share of CSA type across our institutional term loan data, and whether it's a flat spread adjustment, a curve, which is based on interest rate tenor, 1 month, 3 month, or 6 month, or if there's no CSA at all. And this helps highlight the point made earlier about a lack of consistency with regard to a market norm here, because you can see each month seems to vary. One trend that is clear is the share of the 10, 15, 25 time series curve, which is the royal blue portion of the column on the chart. That's waned over time this year in the institutional loan market, while the flat CSAs or no CSAs have increased. And on the right, you can see the difference in loan yields with and without a CSA. Now, this yields chart incorporates all the yield components, so we've put spread and original issue discounts back in. You can see it gapped a little bit wider in May for the deals that had a CSA. However, we've received more May data since this chart was posted, and that gap has closed. So that 7.44% has come lower, and the May data points are practically on top of one another now. So the bottom line is we haven't seen any dramatic difference in loan yields for deals with a CSA compared to those without one. For those without the CSA, they very well could be adjusting the spread higher to make up for the lack of a CSA. And that's one reason why the two could be so similar. But since any potential CSA would be embedded into the spread, it makes it very hard for us to determine what portion of the spread might have been considered as an offset to an actual CSA. So a little bit of a gray area in the data. All right, so moving away from the leveraged institutional loan market, now we shift over to the investment grade market, or those issuers rated BBB or better. In this market, we've seen more of a trend to use the 10 bips flat CSA. The chart on the left shows in April and May, we tracked 37 flat CSAs versus just 3 that instituted the time series. And on the right side, we charted investment grade drawn spreads, which for 1Q and 2Q22 would include the CSA because they would be included if the issuer drew down on the loan. I've also added the triangle markers to show what it would look like if the CSA were not included. So you can see for BBB rated issuers, if we excluded the CSAs, that drawn spreads would be near 10-year lows. And also that applies for single A names, at least in the 2Q data, which is through the end of May. So including CSAs are keeping drawn spreads a little elevated over the levels seen in the second half of last year, but also keeping them from being near 10-year lows. Okay, I mentioned earlier about the direct lending market, and here we have some analysis on SOFR from that market, specifically the sponsored middle market, which is a large chunk of the direct lending market. So these are stats from 1Q22. We'll only start collecting 2Q direct lending data later this week. But in 1Q22, you can see in the top left chart that although the majority base rate used was SOFR at 50%, another 48% still used Libor. And again, these lenders did not have to adhere to the Jan 1st deadline, being that they are unregulated. They'll get there, but it will be a slower adoption than the syndicated loan market. Now for CSAs in the direct lending market, the majority there are using the 10, 15, 25 time series. So that's according to a quarterly lender poll, and that's on the right, and that's from March. So this bucks the trend that seen in the syndicated market where less were using the time series, and goes to what Marco was saying, where there's not really consistency across the market of what kind of a CSA is going to be used. So our second quarter poll is still in progress, but we asked the same question, and the early results showed that the time series is again, the most popular CSA type in the direct lending market. And then looking at yields in the direct lending market in 1Q22, that's the chart on the bottom left. We showed it across two different facility types, unitranches and first lien term loans. And they were flipped in terms of which rate provided a higher yield. Each was minimally, though. And so much so that when you combine the data, you see that it was pretty identical along the right side of that chart there. So 7.16% yield for Libor and 7.15% for term SOFR. But remember, in 1Q22, if the loan had an interest rate floor 50 basis points or higher, that the rate would be irrelevant. So that could be factoring into the closer proximity of yields here as well. So that's the story from the U.S. corporate loan market. We will continue to track all the data I showed today up until that June 2023 deadline. But the story through the first 6 months of 2022 is that the transition to SOFR has gone relatively smooth. We highlighted how loan pricing aligns similarly between Libor and SOFR, and that's despite the fact there hasn't been any market standard settle around credit spread adjustments. There's still some discovery going on with CSAs, and we'll look to see how that evolves over time. So with that, Alex, I toss it back over to you.
Thanks a lot, David. Very, very interesting stats indeed. There has been some questions as to, are we going to share the slides? The answer is yes. And you will be able to have the email address that David mentioned at the beginning of his presentations, where you can, by which you can request the full report coming from LPC. So let's move on to Phil from LCH. Phil, can you give us a super summary of LCH plans with a focus on USD, obviously?
Yeah, thanks, Alex. I mean, if we focus on like a super summary, I suppose there's probably three central things to take away, and that they're probably the same three things as those of you who remember the non-dollar Libor conversions that we performed in the fourth quarter of last year. So number one, we're not going to let the trades fall back. If you have cleared swaps at LCH, we are not going to let those trades fall back, although we are heavily reliant on the great work that ISDA did in creating an economic linkage between SOFR and Libor. So that's number one. Number two, instead we're going to perform a compensated conversion. We're going to take each Libor trade and we're going to replace it with a corresponding SOFR equivalent. And as I say, that's going to be done on a compensated basis. And probably a third thing that's vital for people to take away is all of that's going to happen ahead of the date you mentioned, Alex, this critical 30th June 23 date. That's the date Libor is going away. So the idea is we'll get rid of the cleared swap population as a headache before that date. You know, as David just said, lots going on in the loan market, various other markets as well. So perhaps leave a bit of space for people to deal with those sorts of problems at or around the transition date itself. So for me, I think that would be the the super summary.
Very interesting, Phil. Have market participants expressed any other view about this in terms of relative liquidity so far?
Yeah, I think that is a really interesting question. We've got some data up in front of the audience right now. So maybe 18 months ago, the market was still very heavily dominated by LIBOR-based swaps activity. Certainly in notional, you were up above 80% in risk terms in PVO1, even above 90%. But certainly those trends you can see in terms of notional, that's not as great an indicator, but you can see we've now reached a position where in all of the three active swap market benchmarks in dollars, we've got a pretty even split by notional. But I think what that doesn't show you, which is much more evident in the bottom chart here, is that in risk terms, so like maturity weighted notional, you are really seeing that that SOFR liquidity now as the dominant risk factor. That's really taken over from LIBOR, and also obviously the Fed funds is there, mainly a short end product, no longer relevant for cleared swap discounting, although we know it's still relevant for valuation in certain bilateral scenarios. So yeah, I think the fact that you're seeing as much as 80%, even above that in the very long end, as SOFR-based liquidity, then I think those reservations that people may have had, as I say, going back perhaps a year or so, that they've dissipated entirely. And I think people now, from what we hear and pick up, is that people are very comfortable now with the idea that we're going to convert them across into SOFR-based contracts.
Thanks, Phil. Can you give us a bit more detail about the conversation going on around clearing rates derivatives?
Yeah, I mean, so I guess I mentioned those three central factors, and we've got a bit of a longer list here in front of the audience now. Let me elaborate a little bit, if you like, on some of those three central ideas that I mentioned. First, really want to reinforce this idea. This is, an explicit contractual conversion. The contracts that you will get on the far side of LCH's cleared swap conversion, and they are explicitly SOFR-based. We will have removed the references to LIBOR, at least beyond LIBOR's representativeness. So how do we do that? Well, essentially what we're doing is we're taking sort of the LIBOR leg of the LIBOR-based swaps that we have, and we are substituting those, amending those into backward-looking SOFR. We're using a standard backward-looking SOFR as our measure, and then we're adding the spread adjustment. Those are the ones that were crystallized more than a year ago now, when the index cessation events happened in March 2021, and you've got that little table towards the top right, which indicates what those spreads are. And really, that's all about providing an amended instrument that has really close cash flow matching, really close sensitivity matching relative to the original contract. So, that's a real feature and something that came across loud and clear when we consulted with with the marketplace. We are going to preserve those representative LIBORs. That came across very clearly. People are very happy to make use of the LIBORs while they're allowed to. So any fixing up to and including 30th of June 23, that's a representative LIBOR fixing. So that will be persisted as we go through the conversion. And we're going to cash compensate. So there'll be a small difference between the fallback SOFR profile and the market standard SOFR profile that we're going to give people. and so that will be cash compensated. So there are some other details we could go into. It's going to be done by a process of legal amendment, for example, and we're really providing there on the slide. People can see some of that additional detail around the dates, for example, that I've not gone into. So that's a little more information. I hope that's the right kind of level of detail for people.
Thanks a lot, Phil. Yeah, it's very, very useful. Can you tell us what are the differences compared to the non-USD Libor conversions you conducted in late 2021 in jurisdictions where the Libor transition is completed?
Yeah, absolutely. I mean, those were, for those not involved, the Swiss franc, yen, and sterling Libor conversions. So the cessation of those benchmarks happened at the end of the year. End of last year, and so we performed a conversion at that stage. Yeah, to be honest, there's far more that's in common than there is that differs, but equally for those who are familiar with those processes and want to know about the differences, I'd probably highlight 2 or 3. The first is relating to basis swaps, so that may not affect some of you who are listening, but if you do have basis swaps, we performed a mandatory splitting of those trades ahead of the conversion. In the case of non-dollar trades, that isn't going to be the case. We are not going to perform a mandatory splitting of basis swaps. We'll give everybody a unilateral capability, so something that they can do at their own discretion under their own control, but we are not going to impose a splitting. For the real detail-oriented amongst you, we are doing a slightly different approach on zero coupon swaps. Again, won't affect a lot of people, but if you have zeros with us, we will be converting those using a process that's giving a better fit between the input and the output contracts, which therefore improves the risk continuity, also helps to reduce the PV that we need to exchange to compensate. And maybe the final difference to highlight again is on the dates. We're going to do both of our conversion events will be in the second quarter of next year, so about 9 months away. Both of those events will cover the entirety of the product population involved, and we've split by product into Libor Fed funds, basis swaps, variable notional swaps, and zeros that are going to get converted in an event at the end of April, and then everything else is going to get converted in a process at the end of May. And maybe, Alex, just before I close, all of this is a proposal that we consulted on formally with our users, and we closed that consultation about 2 weeks ago. We're just working through the responses. We're going to issue a formal notification of the outcome. So what I've outlined there is really the proposals that we made. I think we are getting a sense that there's really good buy-in amongst our user base. So I think it's reasonably likely that that we'll stick with a lot of these proposals, but the formal communication confirming that will be probably next week. So yeah, so that's kind of the differences. More that's similar, but those are the differences.
Thanks a lot, Phil. It's great to have this information during the webinar. Thanks again. I think we've replied to all questions in the Q&A. There is maybe one for you, Phil. Is LCH planning to introduce and clear any AXI-based derivatives to link with Marcus' presentation?
Yeah, we don't have any immediate plans on that. I mean, from our point of view, we are always responsive to market demand. We have responded in the case of one other credit-sensitive rate, and that was really because our users indicated that that was something that, that they needed. Equally, I think we have to be respectful of the fact that there is a market best practice on inter-dealer use in swaps of term SOFR. So that's something that I think is possibly under review within forums such as ARC at the moment. So that's something we're keeping an eye on. But you know, as David said, a lot of uptake in the loan market of term SOFR, and to the extent that end users want to then bring that across and hedge in their derivatives, I think you know, we'll look at any and all benchmarks that you know, that merit the clearing eligibility based on demand. So thanks for the question.
Thanks. So again, we will share the slides. Some of you have asked for the email address to get the report on US loan markets. It's here on the screen, but as you will receive the slides, you will find the address. We have recorded, so we will provide a link to replay the webinar if you want. One last question probably for you, Phil, from Marta. What will happen to those basis swaps which are not converted through the unilateral basis swap functionality in LCH?
Interesting question. Yeah, well, essentially what's going to happen is that they will convert as they are. So I think the key there is, if you can imagine, on a swap that's got one LIBOR leg, we perform the following conversion. We convert the LIBOR leg into a SOFR-based leg according to the rules that we've got, and then we leave the other leg alone. In a swap that has both legs linked to LIBOR, then really we're just going to follow our rules on both sides of that swap. So what will happen is we will get a SOFR-based output on both sides of that trade, and we are aware that that's not an actively traded market at the moment. People wouldn't typically trade SOFR versus SOFR, but what we're doing therefore is working with other infrastructures, for example, some of the confirmation platforms, really just to make sure that if people haven't split those basis swaps and then they do find that they go through the conversion process into a SOFR instrument, that they're able to act over those conversion outputs. But maybe I'll just round out the question by sort of asking the question that wasn't asked, which is, why are we not splitting those basis swaps? I think the key feedback we got there was that you know, it does tend to create potentially additional long-lived notional through splitting. So if you take a 100 million basis swap and you unzip it, then you're creating potentially 200 million of notional as well as two line items. So the preference was leave it in my control, really. Let me do it. If I want to do that, that's great, but at least let me control it. Don't enforce that upon me. So, so I know that wasn't the question that was asked, but hopefully that just rounds out the question.
Thanks, Phil. One for you, Marcus. Do you know if AXAL calculation exclude or include unsecured loans?
Yes, I saw that one on the chat. That's probably a good question to ask Invesco, but I believe the answer is no. It's US banks. I saw one other quick question, if I can, Alex. I know there's only 1 minute left, regarding SOFR X adoption. We've received a wide range of interest from investment banks, asset managers, commercial banks, central banks, and the questions around how systems take into account two different floating rate spreads. And in fact, with SOFR X on simple daily SOFR X, average SOFR X, and compound SOFR X, it's actually only going to be one rate. And then if we do a term SOFR X, that will actually be two different rates consumed. And the conversations we've had with the largest financial institutions, the systems are extremely sophisticated. There's no issues at all. We've also spoken to loan system providers at the medium and smaller size bank. No issues there at all. And then we've got fantastic market data partners such as Refinitiv, whose systems are sophisticated, and so we don't see any issue there at all.
Thanks a lot, Marcus. I would like to thank all my great speakers. I think it was an excellent webinar, very informative. So we'll share the recording, we will share the slide deck with the audience. And if you have other questions, you will have the opportunity to send them directly once you receive all those links. And thanks again for joining, and see you soon.
Thank you, Alex.
Thanks, Alex.
Thanks, Alex.